Is the stock market crash over? What's next for the stock market? I'll try to answer that question, plus do my regular weekly market analysis. We'll do a market scan in search of opportunity, and I will look at the day trade of the week on SGRY, all coming up in this week's Stockscores Market Minutes. Okay, so we've had a pretty good comeback in the markets in the last couple of weeks, and that has many asking, has the bottom been made? On the other side, people will argue, well, we haven't seen the negative earnings that will come from the big economic slowdown that came out of the COVID-19 pandemic. We should always think, however, about what the market prices in. You know, the market came down a lot, and that is priced in a lot of negative expectations for the future in terms of earnings and that sort of thing. And when we're thinking about what will happen next for the market, we should not judge it based on what we already know. We already know that earnings will be bad, and that's why the market went down so much. The question is, will they be as bad as the market has priced in? And this really leads us to what ultimately makes markets move in dramatic fashion, and that is surprise. When the market is surprised by something that it doesn't expect, that's when we get big moves in the market. So the next wave of the market's move will be based on new surprises, and we must focus on what the market does not know yet. Now, I don't know what the next surprise is going to be, and either do you. However, there will always be investors in the market who will identify that new surprise before most of us. And when they do, they will create the abnormal trading activity that tells us what to do. We have to remember that the stock market is not fair. There are some investors who can uncover better information than others. Now, the market already knows that there is a COVID-19 virus. It already knows that that virus will have a negative effect on earnings. It's what the market doesn't know that is going to make the next move. And that could be something like opening up international travel, or it could be that there is a new wave of the virus coming in that's going to have an even bigger negative effect. And so ultimately, we just follow and do what the charts tell us to do. So let's take a look at the chart of UAL, which is really a great example of a stock that was beat up a lot by the virus. Now, people will say, well, airline stocks, of which this is one, will really suffer negative earnings. I don't doubt that at all. But the stock has come from $90 down to $20, and now it's at $30. So it's suffered already a huge amount, and I would argue that it has priced in a lot of negative news. And it will only move lower if there is something new and negative that makes the market reevaluate the $30 price. And we'll know that something new and negative is coming in if it breaks this upward trend line with a strong move to the downside. On the other hand, if something positive happens and the market is able to break up through this downward trend line, then we can start to say that the expectations were too negative and they're going to get better, and therefore this stock is destined to go higher. And you can apply this thinking to any stock, any market. We want to look for the surprises. And the surprises show up when there is an abnormal break from low volatility. Now, as I go through the market analysis, I'll talk a little bit about how to watch for those things, but it really is that simple. If you can draw some trend lines on the chart and then look for abnormality, much like we had this abnormal move right here out of this compressed volatility, and that led to this, if we can break out of this new compressed volatility, we will know which way we're going to go. If we break to the upside, we're probably going to move higher. If we break to the downside, we're probably going to move lower. That's what we need to watch for in determining whether the market crash has indeed run its course. All right, let's go on to this week's market analysis, starting us off with the S&P 500 chart, which you can see is in a nice upward trend on the short-term time frame. It broke the downward trend late in March right here, and that has started this upward trend. I would say the upward trend is losing its momentum. We have something called a rising wedge pattern. What that means is that the bottoms are rising faster than the tops are rising, and that is a sign that the buyers are getting less motivated, less excited. So what we need to watch for, and what I'm concerned about, is if this upward trend line is broken with a downside move. So for now, I am bullish short term, but I do sense that the momentum is starting to slow to the upside in the short term, and therefore we want to watch for a breakdown, because if that happens, we may come down into this level or possibly even retest the lows. There's no sign of that yet, but that's the key thing that I'm watching for. As long as we're in this pattern of rising bottoms, I remain bullish short term. If we break that cycle, then we need to get defensive again. Long-term chart, you can see that we had the dramatic sell-off on the weekly and we've made a V bottom. I do think we are due for a little bit of a pullback because we've retraced half of the loss. So you can sort of cut that in half there. That's what we call a 50% retracement. Anyone who understands Fibonacci numbers will know all about that. And it's a good reason to think that we should pull back, but I want to emphasize there is no sign of an impending pullback. It's just one would make some sense if it did happen. But until it happens, we have to count that the bottom has been made and that we're going to continue to recover. Looking at the Russell 2000, which has lagged a little bit the larger cap stocks, but we do have rising bottoms here. We're in this sort of upward sloping channel. Probably get up into this range and then maybe pull back. There's certainly not the same level of bargain hunting and bottom fishing in the small cap stocks, and perhaps the concern is that some of these smaller companies don't have the balance sheets to endure an economic slowdown. We will see, but I think you have to be a little more picky on those small cap stocks than you do on the large. Onto the Canadian markets, and you can see that the TSX is in a similar sort of pattern as the S&P 500. We broke the downward trend line here. We made a rising bottom there, and we're just gently moving higher, not with much enthusiasm, but still the bottoms are rising over time. That means in the short term, the buyers are in control. In the long term, we're essentially doing what the S&P has done. We've recovered about half of the loss, and that is where it gets to be sort of judgment day. Are we going to break through that 50% retracement, or are we going to roll down and try to make a rising bottom? I would actually prefer that we pull back a little bit. It'll recharge buyer interest, give us some more bargains in some of those beat up names, and allow a greater level of confidence for the recovery going forward. But for now, there's no sign of weakness in the short term, and so I remain bullish in that time frame. Looking at the TSX Venture, you can see that we have broken its downward trend line. We've built a rising bottom. We broke the rising bottom, and we're now in a nice little upward trend. I would stick with these names if you find bargains that have good price charts that are worth considering, but be picky. Not everything's going to survive the big economic crunch. On to currencies, and the US dollar had lots of volatility around the correction. We went up a lot, we went down a lot, and we're essentially back to where we started just a few months ago. And so I would say that perhaps, given that the market had broken down prior to the correction, we saw that breakdown from a falling top, I think we're probably more likely to see the US dollar roll over a little bit as things stabilize. But for now, it's relatively a neutral chart. The Canadian dollar got really beat up largely because of the weakness in oil. Of course, the Canadian economy heavily based on oil, and we can see the breakdown there. We are making a little bit of an attempt to come back, but it's not with a lot of enthusiasm. And so I think we really need to see the US dollar weaken for the Canadian dollar to stabilize. So I'd be still fairly pessimistic on the Canadian dollar. On to interest rates, and you can see that we are still in an upward trend for the bond market, which means interest rates are still in a downward trend. Nothing really has changed here from past weeks. Commodities, gold, I talked about it last week, how gold had risen up to resistance, and at the start of the week it managed to break through and made me look bad, but it cooperated, and by the end of the week it had retraced, and we're essentially closing where we closed the previous week, and I think we are still due for a bit more of a pullback on gold. Oil really suffering. It's got that parabolic move to the downside. It tried to bottom here, and it's still holding those lows, but it really needs to bounce back soon. It is heavily oversold, due for a bounce back, and I do think it will happen soon, but it still hasn't given us a strong indication that it will. So I would actually watch something like the 30 or 60-minute chart on the price of oil to see if we can break a downward trend line from a rising bottom. Use that crash reversal pattern that I've talked about in recent weeks, where we have the downward trend is broken, we build a rising bottom, and then we break up from a rising bottom. That's what we're looking for on oil, and apply that to a 60-minute chart for oil if you are looking to bottom fish, bargain hunt some of those oil and gas stocks. And finally, the fear chart. It is coming down, but it is still not low by any means. We obviously had a very parabolic run higher. We're starting to come back. If the market continues to rally, I expect that this will continue to move lower, but the fact that it's still quite elevated shows us that investors are still not confident that there may not be more weakness still. So I think that there's still some potential for more weakness. We don't have any sign of it yet, but if the market starts to break down, then this VXX is a way to profit because it will move up if the market breaks down. So watch those charts on the S&P 500, for example, for a break of the upward trend. And if so, if you're looking for a place to play, take a look at the VXX as it should move up if the market starts to crash again. So my ratings then, I remain neutral long-term and bullish short-term on both US and Canadian stocks. My rating on gold is now neutral on both time frames. Oil, bearish long-term and neutral short-term. Market volatility has compressed, but there remains plenty of opportunities if you are a nimble short-term trader. We're seeing hot stocks every day, but you got to be picky. With the short-term trend up, we should continue to look for stocks making reversal patterns, showing abnormal behavior, but don't chase after strength. If a stock is up many days in a row, it gets risky and you need to dance close to the exit door. Gold is looking a little top-heavy right now, while oil is oversold and deserving of a bounce. And as I said, fear is coming down, but fear is not gone, so let's remain cautious. All right, next up we're going to do a market scan on Stockscores. We're going to jump over to the Stockscores website, go to the market scan tool. This is how I find longer term trading opportunities, not really for day trading, but if you're looking for longer term position trades, we can run something like the abnormal break scan. That looks for stocks making abnormal gains with strong volume. And I found 22 stocks with the scan. We'll just quickly go through some of the charts in search of good patterns. So the first one, ENSV, you can see had a very strong day on Friday. It broke the downward trend line from a little rising bottom, very strong volume. My concern is there's quite a bit of resistance in this zone because of a lot of volume that traded that price. And so therefore it's going to take a fair bit of volume to break through that. I think this is an okay chart. It has some promise. I'd rate it a 6 out of 10. As we go through these, I just want to emphasize that there's a certain amount of skill required in learning how to read chart patterns. I can teach anyone how to do that. We have an upcoming course starting late in April, and if you check some of the other videos here on the Stockscores YouTube channel, you can learn a little bit more about some of the bonus education that we're doing in April to help you understand this stuff. All right, so AM looks also decent. It's got that downward trend line. It built some rising bottoms, and it's starting to move to the upside from this level. I do think it's more likely to go higher than lower. I don't think it's a super high probability trade because of the lack of volume. You can see that it's moving up, but without that volume supporting the move up, it's not as a high probability of success as possible. So I would rate this a 6 out of 10. All right, moving along, let's see if we can find something good here. CalAmp, C-A-M-P. I actually think this looks all right. We're breaking through a little bit of short-term resistance from a rising bottom. I think it probably can get up into this $8 or $9 level. Again, the main issue here is the lack of volume. I'd rate this a 6 out of 10. Moving along, Wide Open West was a good day trader on Friday. I don't like it longer term. I just think the upside, maybe $7.5. It's at 6 now. When you think about reward for risk trade-off, it just doesn't have enough reward potential for the risk you have to take. Here's TROX, and it has a little head and shoulders bottoming pattern. You can see the downward trend line here. My drawing tool isn't working for me right now, unfortunately, but just visualize drawing a line across the tops, and you would see that this break of the downward trend line with strong volume from a little rising bottom, that's pretty good. I would actually give this a 7 out of 10. I do like that pattern setup. And so we can continue along and just give these quick numerical ratings. MGNX, I'd give a 6.5 out of 10. That means I think it has a 65% chance of moving higher in the near term. Why do I think that? It's all based on the pattern. Rising bottoms, breaks of trend lines. Here you see Sohu, S-O-H-U, breaking a downward trend line from a rising bottom. Great pattern, Problem here is it made a pretty big gain on Friday, and so the risk reward of this trade is not great. Perhaps on a pullback, if it can get down below $8 again, it would be worth considering. But I think here it's just not quite the risk reward trade-off that I like to see. Similar situation for SGRY. It was a great day trader on Friday, but the gains on Friday were so big that to enter now in the $10 range, I just feel the risk reward isn't worth it. If you own this stock, I think it's worthy of a hold in the short term, and I just wouldn't consider it a great buy. So we'll go through the rest of the charts on this page, and hopefully you're starting to see the power of the tool, first of all, to be able to look through lots of different charts, but also getting a sense of what I'm looking for in these charts, this idea of breaks through resistance from rising bottoms, which is really a break from optimism. Again, all of these things taught in the investor course, and we use the same concepts when day trading in the active trader course. HT will be the last stock that I look at. See the little jump in volume on Friday, breaking the downward trend line, breaking out of that little sideways trading range. I think this looks pretty good. I would give this a 6.5 out of 10. All right, so jumping back, let's look at the day trade of the week. And of course, day trade of the week is something that I perhaps did on Active Live, which is one of our services for day traders. These are not trades you would consider today. I just do it for educational purposes to show you the different potential that we have with day trading. So let's take a look at SGRY, and you can see the setup here. It had an action candle on the second bar of the day. You can see little pink dots there. That is my action candle indicator. And in this case, the position size for $100 of risk would be 400 shares. The capital required for that would be $2,944. And the margin, if you use margin, you would need about just under $1,000 of capital to take this trade. Well, by the end of the day, it had closed at just below 9 RR, reward for risk, which was an $890 gain on a position that required $990 of capital. That's a wonderful 89% return on a one-day hold. It was one of the stocks we talked about on Active Live on Friday, and it turned out to be a big winner, very liquid, very active, and we're getting a few of these every week. There's always some hot stocks. Another one last week, CODX, which actually made over 20 RR. So you have to be patient, you have to be selective, but these trades are coming, and you just need to know how to take advantage of them. Hopefully some of you will participate in Active Live and learn more about how to do it. That has been the Stockscores Market Minutes for April 20th, 2020. Hope that you have a great week in the market and trade well.